And welcome all to our most recent update on our economic forecast. This is by far and away the biggest crowd that I've seen around the country so far, so that's pretty pleasing to see. And I think you'll find we've got a few interesting things to say. As noted, if anybody's got a question, please sing out as we go through, and I'm happy to respond to that. There will be a test at the end, so please listen carefully. So firstly, I've got a few slides there just basically giving the bottom line in terms of what the kind of core view is about what the economy is going to do in the next few years or so. And it's a picture that we basically see the economy coming into a relatively tough period in terms of the operating environment for sort of households and business. We're looking at a period where growth is going to decelerate. It's going to go down to growth levels of below trend, so for the next few years we've got growth in the order of about 1.5% per annum on an annual average basis, which is, a bit under half of what we sort of saw in New Zealand through most of that kind of 10 years before COVID hit. And that's a period there because the economy is decelerating, growing below trend. It means that some of those constraints, pressures on capacity that have built up that have contributed to very high inflation in the last couple of years gradually be reduced to the extent to which we can see some signs of durable downward pressure on inflation to bring inflation back within that kind of target range. Having said that, and I'm talking about this kind of like relatively tough kind of trading environment, business environment, we have actually upgraded our outlook for the economy since the last time that we came to speak to you back in February this year. The upgrade is significant in the sense that, up until a few months or so ago, we were kind of anticipating that the economy was going to slip into recession towards the end of this year. Our last set of forecasts had a recession starting in December quarter, extending into the early part of next year. And that was pretty much a kind of consensus view around the economic agencies, the Reserve Bank, most of my peers and the other banks as well, and really reflecting the idea that we have a bit of a post-COVID hangover to work off here. Interest rates have been increased quite significantly in the last year or so, and they would be slow in growth, and also we'd be looking at a relatively weak economic environment internationally as well. So, but you'll see if you look at that line, it doesn't actually dip into negative territory anymore. And that's because we no longer see a recession really panning out later this year. We've upgraded our growth outlook. And, at the same time, a couple of weeks ago, perhaps that wasn't a particularly consensus call. But since then, we have actually seen both the Reserve Bank and Treasury come out with revised forecasts. Also, a few of the other banks and agencies around the country also kind of like looking at the same thing and generally taking a more optimistic view about what the economy might be doing in the next year or so, albeit still with that kind of like quite challenging outlook. So then the key question is, well, what is the story with this more optimistic tone? What is going on there that's really driving that? And, the big thing that's really changed for us, particularly in the last sort of few months, 3 to 6 months realistically, is quite a significant turnaround in net migration. So we're in the last year, we've seen 65,000 people come into the country to live and work, which is, pretty big shift. If we look at those numbers from, say, last year, it was a situation where around 20,000 people were leaving. So, that's a pretty decent swing, and it really has kind of caught a lot of us a bit by surprise in the last few months in terms of the size and the speed of that turnaround. And me and my family got off the plane in mid-February, and I'm surprised at just how far the discourse has changed around this issue. When I got off the plane, the papers were all full of the stories about everybody leaving for Australia. Like everybody was going to be leaving, going to be a tough time for the labour market, the economy, because all the best and brightest were going to be leaving us. But now we're totally looking at a different picture. There still is that sense that there are New Zealanders still leaving the country and getting on with doing the things that they've wanted to do for the last few years that haven't been able to do. But that's well and truly offset by the wave of foreigners looking for better places and more opportunities around the world. So like that kind of swing around in migration that we sort of see here, when we kind of look at the data and we kind of anticipate that those inflows are going to continue for at least a few more months yet, means that we'll be looking at an annual number of people coming into the country in the order of over 100,000 on an annual basis quite soon. And that's pretty exceptional even by New Zealand standards. We anticipate that it will drive population growth up for the next year into the order of around about 2.5%, which is what this chart is that we've got here. And you'll see that you have to go back a long way to see that sort of population growth. It's 1961, in fact, is the last time it was this strong. So this is a pretty exceptional period for New Zealand. May not necessarily feel like it just yet, but it is pretty exceptional. And what that means is that if you've got that many people coming into the country, if you've got the population growing by that sort of level, it's pretty hard for the economy to go backwards. Because whilst on an individual basis, individual businesses may not be doing so well, individual households might be doing it a bit tough with cost of living pressures, rising interest rates, because there's more mouths around the table basically means that there's a lot more supply of resources into the economy and also a lot more demand of resources in the economy as well. So, that's why we're really struggling to see this economy slip into recession while these sorts of trends continue. So what are the implications of that for interest rates and inflation? So, a couple of weeks ago when we released our QEO, we put in a view that we saw a case for 2 further interest rate increases to 6% over the course of the next 3 months. And the motivation for that call was the fact that this upward revision to the growth profile and the associated upward revisions to the extent to which we can expect excess capacity to be created in this economy to bring inflation down from these very high levels has just been reduced. A starting point coming into this projection round is that we didn't really see very much room from the Reserve Bank's perspective to be able to accommodate upside shocks to growth or inflation for quite a while to come, given that quite high starting point for inflation and the distance that needs to be travelled to get back to that 1 to 3% range. This shock in migration, as I've explained to you, is very large, very exceptional, will have a reasonably prevalent and significant impact on the economy, and we couldn't do anything else but conclude that it will basically require some additional interest rate response to be able to balance the inflation risks that might come from that extra growth that we expect to see. So we put in those 2 interest rate hikes, but then what happened last week? Well, there were a couple of key events. Well, first thing is the government came out and gave their budget, came out with a much more stimulatory budget than we actually anticipated. When we were putting together these forecasts, we took the view that the government was telling us that this was going to be a no-frills budget, right? Basically, stay within the operating allowances, basically watch the pennies, try to limit the amount of extra debt that will have to be issued. Often the argument for that was that was a good way of restraining the impact on inflation pressures in the economy. The reality was that we actually got a bit more than that. We actually got what looks like a pretty significant fiscal stimulus coming in the next year, 1.6% of GDP. That in itself, in our framework, would add a bit of inflation pressure and the need for higher interest rates. The Reserve Bank indicated when they came out later in the week they weren't so sure about that. They basically said, yes, there's this extra stimulus, but then if you look at the profile for fiscal spending in the years after that, there's quite a significant fiscal contraction implied in those projections. So they basically took the view that they could balance those two things off. We're not really that convinced, frankly, about that argument. We know we have a fairly high degree of confidence we'll see the stimulus in the next year. But we've got no idea who's going to be in the government next year. And even if you did know who's going to be in the government, what policies they might have to employ. And even on the baseline that Treasury shows, it implies a very significant cut in spending per person, given the strong population growth we can see now, which means, it kind of implies a fiscal consolidation that would make Ruth Richardson's eyes tear up. And we just wonder if that's really realistic in terms of what we can reasonably see in the future. But the other thing, what the Reserve Bank told us last week is that they actually thought that 5.5% interest rates was going to be adequate for the time being to be able to restrain inflation pressures. So we're suggesting that it needed to be close to 6%. They're saying they're pretty happy with the idea that 5.5% is about the right number. And we had to respect that view when they come out. I mean, we've got another OCR review coming in another month or so, and we kind of recognise, well, given the strength of that view, it's pretty hard to see the Reserve Bank changing their minds quite that quickly. But we still believe our story. We still believe that this migration cycle in particular has a few legs to it yet. When we talked to the Reserve Bank and Treasury about what was motivating their views around these factors, we were not convinced that they necessarily had any better idea about it than we did. I feel like, Michael, for example, has been doing a lot of work in the migration space in the last few months, and I think is very much the leader of the pack in terms of understanding what's going on there. So we think that as they have a look at the data in the next 2 or 3 months, they might have another think about this. So we still think that there's going to be an interest rate increase in August, 5.75%, and some risks that will have to go up to that 6% level ultimately sometime later in the year. But we'll see how that data pans out. I mean, basically the Reserve Bank has taken a view about what they think. We've got our view, and we'll all be looking at the data to see what happens. Nevertheless, it doesn't matter who you talk to, ask the Reserve Bank. No one's talking about interest rate cuts in this economy for a long time, right? Reserve Bank basically saying interest rates on hold at this 5.5% level till the second half of next year. We pushed out the timing of when we thought we might see the first interest rate cut to more like about June next year. We did that because on the logic that, well, if we're not going to get as much tightening now to bring things under control, you need to balance that off somehow. And we didn't want to balance that off by creating more inflation in the outlook. So we said, right, well, the one way you can do that is to basically extend the period at which you keep interest rates in restrictive territory. But there's still plenty of risk around that sort of idea. But either way, this sort of notion that sometimes financial markets have gotten into that there could be interest rate cuts coming quite soon seem the wrong question, the wrong sort of view to sort of be focusing on now. We think the kind of relevant question is how high will interest rates have to go and how long will they have to stay there, basically. And next year, if we see signs of a weakening labour market, weakening economy, sustainably weakening inflation pressures, then we might be talking about what kind of interest rate reductions might be possible. The inflation outlook is pretty worrying, really. I mean, look at where we are. Yes, we are in a position where the headline inflation rate looks like it's peaked. Looks like it peaked a couple of 3 quarters ago or so. Inflation's still at 6.7%. Target's 1 to 3. Middle of it's 2. So what? We're over 3 times the target. If you think about the middle of the range, over 2 times the top of the range. There's quite a bit of daylight between where we are and where Reserve Bank ultimately needs to be. And I mean, as Chris mentioned, I spent a bit of time at the Reserve Bank working, sort of sitting on the MPC, kind of contributing to this sort of decisions about how to operate a monetary policy cycle. Most of the time in my career, we were focused on the problem of maybe trying to reduce inflation by 1% or so. And with that sort of size scale of problem, you can kind of think about an interest rate cycle that might be 75 basis points, 125 basis points high. Bringing inflation down by 3, 4, 5 percentage points is an entirely different issue. Frankly, one that's quite a big job, something that you shouldn't anticipate that will happen easily or quickly. Hence that view that even on our forecast, it's going to be another 18 months before inflation comes back within the range. And that follows a 2-year period of being outside the range. There've got to be plenty of risks there around the inflation rate, the potential for inflation to kind of be embedded in wage and price setting behaviour in the economy. And while we haven't assumed that any of those sorts of expectations and behaviours will be substantively affected, the reality is there's a risk it could. And if it does happen, then that red line will not go down as fast as what it says here. And it certainly won't go down as fast as what the Reserve Bank thinks either. So, every economist in the country, I say, is probably operating on that same assumption, perhaps hope that everything remains pretty well anchored, but we're in pretty exceptional times here. This is a risky environment from an inflation control perspective. So getting into some of the more details of the view that we have here, so I just took you through the kind of profile of what the growth trajectory looks like. We're basically seeing slowing, sub-trend growth. We need sub-trend growth because if you don't get sub-trend growth, then inflation won't fall. That's just the reality. But we do have this kind of thing that's pushing us in the opposite direction, which is this migration cycle. These are our migration forecasts. It's by far and away the biggest factor that's actually shifted in our projections in the last sort of few months. You can see there that, much of this big bounce back in migration that we saw is already in the bag. It's data that's actually been released. We're at 65,000 for the year already. We go through the next few months, you've got numbers from a year ago where people were leaving, dropping out, or perhaps very small amounts of people coming in. If we see monthly numbers anywhere close to what we've seen in the last few months, this is going to 100,000 people. So we haven't got a particularly aggressive view in our mind for what this migration cycle is going to do in the near term. It does vary a bit with what the Treasury and the Reserve Bank told us last week. Treasury, unfortunately, had to do their forecasts a couple of months ago in terms of when they finalised their figures. So, their projections for migration, they were already probably got about half of the starting point is missing because they just missed some of the data in the last couple of months that they didn't have. So they accept that they're going to have to upgrade their view pretty significantly as we go into the preview and the half-yearly update after the election. The Reserve Bank finalised their forecast a bit more recently, but they took a bit of a different view in that they had the kind of right starting point, but they took this view that actually the migration cycle was finished. Well, it actually already finished with the last lot of data that we had, which I think was for the month of April, if I remember correctly. We think that's a courageous decision to take, but that is what they took. They justify it on the grounds that they don't know, and they'll look at the data and see what happens. But as we noted, we think they'll see some data in the next couple of months that is going to force them to change that view, unless something untoward happens. And so they're going to have to accommodate that into their view somehow when they come back to talk to us again in July, and especially August, when they will have had at least a couple of months of migration data plus a whole host of other indicators that they have to think about in terms of what the inflation and economic outlook is going to look like. Both the Reserve Bank and ourselves probably have similar views about the medium-term direction of migration. We've basically both got it kind of heading back towards sort of pre-COVID averages, although in our case what we have done is incorporated an extra 100,000 people coming into the economy over the course of the next year or so. Why do we pick that number? It's because when we look at the number of visas that have been issued for people to come and live and work here in the last few years, there's 370,000 more of them been issued than people who turned up. And best as we can tell, most of those visas are valid for 3 years. So, maybe they'll all turn up. We don't think they'll all turn up. We're sure that some of those visas are probably stale. They found other things to do. Perhaps they changed on to a different visa, so there's a bit of double counting. We don't have much clarity on any of these issues. We'll be looking into it to the extent we can in the next while. But we thought 100,000 was a reasonably conservative estimate to at least put in to sort of work on the basis of. And hence that's why you see this kind of still quite chunky migration profile sitting in our forecasts, which provide a pretty steady fill-up to economic growth through most of the projections horizon relative to that quite negative outlook that we had previously. Last thing I'll say on migration as well is that this is not a New Zealand specific issue. This is not something that is just happening in New Zealand, it isn't happening anywhere else. It's actually happening in Australia. If you follow kind of what's been going on in Australia, you can see that if anything, their migration cycles may be a bit further advanced than ours, and they're starting to see the flow through to things like rents, house prices. That's certainly the case. but it's also happening in the United States, in Canada, even in the UK, even in Germany. I read some stuff about this. There's an article in The Economist this week actually talking about the surge in migration that relatively wealthy countries like New Zealand are seeing in this post-COVID environment. So it kind of reflects that global shift of people who wanted to do something different in the last few years during COVID, who either couldn't because borders were closed or weren't comfortable because maybe they were concerned about the health implications. Those barriers have come down now, and people are now moving to take advantage of the opportunities that they now see. To our mind, that means that we think this cycle has got a few legs, that it isn't necessarily reasonable to expect that it's all just going to turn around really quickly. We'll turn around sometime. Your guess is possibly as good as mine about exactly how high that peak is going to be or how long it will going to last. We'll be revising our view as we see the data pan out in the next year or so. But yeah, I mean, we think it's going to be here for a while yet, and it will have those implications on the economy that we've been talking about before. In terms of the outlook for the labour market, interesting story here. Stronger growth basically means that whilst we still anticipate that the unemployment rate is going to drift up over the course of the next year or so, it's going to drift up to a lower peak than we thought a few months ago. We used to think that the unemployment rate might head up to close to 5.5%. Now we see 5% as a reasonable target. That's a little bit lower unemployment rate than the Reserve Bank kind of sees. I think they're closer to 5.5%. Everybody's tended to revise their view in the same direction, though. And that reflects the fact that, we've got a slowing economy, so therefore we should expect, in fact, we need to see that slack open up in the economy to be able to generate those disinflationary pressures that we kind of need to bring inflation back to target. But it also means that, with all of these people that are coming into the workforce, we're anticipating that, most of them are going to find jobs and they're going to add to the supply potential of the economy. They're going to make people running businesses, they're going to make their lives easier because all of those businesses that have been really starved for staff in the last 2 or 3 years are going to find it more easily. So that's good for the supply side of the economy, but it'll also create a bit of demand as well. For a start off, all these people are coming in, setting up households, finding somewhere to live, kids are going to go to school, they're going to go to stores, restaurants, etc. That's all kind of good demand for the economy. It also means that to the extent to which the supply of labour has actually restricted firms' ability to actually do the things that they wanted to do, those restrictions should be eased. Think about that restaurant that hasn't been open at lunchtimes or had to close 2 days a week because they only had one chef and the guy needs to have a day off. Think about all those complaints we've heard down in Queenstown about not having enough people on hand to be able to pour pints or serve food to the increased number of foreign tourists that are turning up here. Those constraints will all be reasonably well alleviated in the year ahead, and that generates activity and activity in the economy. And that's kind of the demand that we kind of see as relevant when we're thinking about what the inflation outlook is going to do. The other thing I would say here is that we also had a view a couple of weeks ago when we put out, was a bit non-consensus, that the bottom of the house price cycle is probably in. A couple of factors there kind of drove us to that conclusion. One is that some of the more recent house price data was showing some signs of consolidation. We've had a pretty decent adjustment in house prices in the last year or so. House prices down 17% or so from the peak on a national basis. Obviously quite a bit more if you do it in inflation-adjusted terms, considering that inflation's been quite high through the period. Pretty big adjustment by New Zealand standards. But also, this migration, this population growth, it's hard to see how that shouldn't create some demand for housing, either through the rental market or in people looking to buy housing as well. So, whilst we don't really have a view here that the housing market is going to race away, we can see strong arguments for why we shouldn't necessarily expect significant further falls from here, particularly if it's the case that interest rates are either at the peak, if you believe the Reserve Bank, or near the peak, which is what our view is. As I noted, that kind of view on house prices is not especially strong at this stage. We've got a model for thinking about how house prices work here, and it's kind of based off looking at housing from an investor perspective. where basically we're looking to kind of balance the cost of housing versus the hurdle rate in terms of the funding cost associated with like borrowing to go into housing, and then thinking about the rental income that you get if you're an investor kind of like buying on housing, and kind of like looking forward in terms of sort of like the relative balance between those cash flows are. And we see there that model, notwithstanding the fact that house prices have significantly corrected, they still look a bit overvalued from an investor perspective. So what that means is that we don't really see this as currently an environment where the investors get really excited and charge in and buy investment properties. It's more likely from our perspective that the housing market would be more dominated by either first home buyers or owner occupiers, people that have already got equity in and are looking to kind of like move houses or something. And there's probably a decent stock of those people that have been sitting on the sidelines for the last year or 18 months because they expected house prices to fall and they were worried about interest rates going up, and perhaps they were worried about the economy turning down as well. At least two of those three factors look like they've been significantly alleviated in the last few months. Hence, that kind of like sort of makes us think that whilst the investors won't be there, those other groups will be, and we've got this view that house prices will basically truck along at around about the level of inflation. But as I'll explain to you later, there's a few risks around that view, and important risks to think about. That means we'll all be looking pretty closely at that data in the next sort of 6 months or so, particularly in light of some of the trends we can see in Australia, for example. So in terms of the kind of components of the economy that are going to do less well in our view, consumption, household consumption and spending is that kind of like sector which we still see as doing it pretty tough in the next sort of year or so. This is one of our kind of favourite charts. It was our chart of the week this week in the weekly report, basically showing this yawning gap that's opened up between nominal spending, which seems to be holding up reasonably well, in the last 6 months or a year or so, but whereas real spending is basically going sideways. So people are spending more money for the same amount of stuff. That's not a very strong economic sign, but it's entirely consistent with those indicators of consumer confidence, business confidence, which are right on the floor at the moment, that realistically probably scream recession to some extent as well. It basically suggests that kind of like sector is under pressure, and we expect they'll remain under pressure for a while to come, because the interest rates are still going to be high. Maybe the cost of living and pressures will improve, but the labour market's going to be a bit weaker at the margin as well. Okay, so that's an area of weakness. If you look at our kind of the composition of growth that we sort of see in the next year or so, household spending is not a strong point. The other area is in construction, where we actually see that as being a pretty weak point as well. That's just a reflection of the fact that house prices have adjusted significantly because of the high interest rates that have occurred in the economy in the last year or so. We kind of can see some forward indicators of that when we look at how dwelling consents are kind of like percolating through. There's sort of this leading relationship between house prices adjusted for inflation and dwelling consents. Dwelling consents themselves obviously leave actual construction work being done. View there is that the construction industry is working through that pipeline of projects that were organised a couple of years or so or more ago. So there's still a reasonable amount of activity occurring there now, but we don't think it will last. We think it will slow down in line with this, what we've already seen in house prices, what we've seen with interest rates. After that, because we've got this view that inflation-adjusted house prices are going to be pretty stable after that, it basically doesn't really imply much of a strong bounce back in construction either. So yeah, the story there, construction sector, residential, business investment, pretty weak. And I guess, a reasonable question that we get a bit is, well, you guys at Westpac are talking relatively optimistically about the economy and that we're not going to get in recession. But why do I feel so bad? Why do I feel so bad? Why is it when I pick up the newspaper I read about consumer confidence being at the worst level for 30 years, like lots of tales of woe and despair, from business confidence, consumer confidence, and those are real kind of like indicators that are usually quite important to economists when we're kind of thinking about what the economy is going to do. And, the way we square that circle is when we look at the implications of our forecast profile in per capita terms as opposed to absolute terms. So what we've got here is we've got a picture that output, GDP, consumption spending, it's running along at relatively low positive levels. It's not a strong outlook, but what is really strong is population growth. So basically, you can think about it as like individuals are getting a smaller slice of that GDP pie because there's more people coming into the economy and we're getting some growth, but not as much, not as rapid a growth as that. So like as individuals, it's probably reasonable for a lot of people to feel pretty unhappy, feeling like they're not doing very well because they're possibly not, And, on that kind of per capita basis, you can see here that, that measure on our forecast horizon will look as bad as it looked through the global financial crisis, where we did actually have a pretty bad recession by New Zealand standards. So that kind of helps square that circle, but it doesn't change the reality of if we're going to have that stronger population growth, it's going to drive output growth. And unfortunately, inflation is not driven by per capita household spending or per capita growth. It's driven by the output gap, and the output gap is the level of potential output relative to actual output, and we see both of those factors being significantly boosted by what's going on with the population in the next year or so. The negative outlook for households in particular, we still have inside our forecast that idea that there is still a bit of interest rate increase still to transmit through the economy. This is one of our more popular charts that we've been using for the last few months or so. We're basically moving along that red line and we've got a bit more distance to go in the sense that there's probably still a good 1.5% of interest rate increases still to filter through to borrowers as they go off from those really nice 2-point-something mortgage rates that they got a couple of years ago to something more like about 5 or 6 point something now. That's going to crimp household budgets. It's the reason why we have that kind of like negative outlook for household spending in the projections. One of the reasonably important reasons why we actually have economic growth slowing despite population growth being relatively strong. So it's absolutely in the projections, but it's just being offset by this other factor, and indeed this factor that nobody was really talking very much about a few months or so ago. The global backdrop for what's going to happen here in New Zealand is a bit interesting in the sense that globally growth is not that flash. My previous employers at the IMF came out with their World Economic Outlook last month, and basically have the weakest outlook for global growth that they've had in 10 or 12 years. So that's not too good, right? But it's not all bad for us because it actually transpires that everyone agrees that, at least in the case of China, there'll be a relative bright spot for the global economy. And that matters a lot for us because they're our biggest trading partner. We're anticipating that we'll see that positive effect come through a lot of sectors, particularly in the agricultural sector and tourism as well, which we kind of like see would be relatively strong. So there are some silver linings there as well. That kind of means that, at least for New Zealand, the global outlook is perhaps not as weak as it might be in some other parts of the world where perhaps they have a different mix of things that they try and sell to the world. In terms of kind of like other positive factors that we've got in here, we're really anticipating that the tourism sector should bounce back, should do, because it did hardly anything during COVID, didn't it? The only people pulling pints in this country were you guys. It wasn't me, I wasn't allowed in. And sure as hell foreign tourists wasn't allowed in either. So, that's come back a bit. We think it's probably back, 2/3 of the way or something like that from the pre-COVID level. We're anticipating to get that back to the kind of like to the COVID level over the course of the next year or so. As tourists come back, should have a pretty decent winter. I believe we've got the Women's FIFA World Cup coming here, so there's a few people coming to watch some soccer. Aussies can come and do some skiing, and maybe in the summertime, people with looking at potentially cheaper airfares from all the extra airline capacity that's coming on in the world. might mean that we actually have a pretty good summer as well in the tourist sector. So that's a relative bright spot that we've got in our projections. It's not all bad. Inflation, that's the tough one, isn't it? 6.7%, explained to you before, that's a pretty terrible starting point for the Reserve Bank Governor. You're very nervous about that. You've got to promise people that you're going to get it back under 3%, hopefully before too long. It's still pretty elevated, inflation, but it has peaked. That's encouraging, right? I mean, at least we're not still going up, which is quite good. Although, I'll look at some of the details in a minute to say that, we just want to be a little bit cautious about what's going on there in the inflation outlook. And as I explained to you before, we've been outside the target for 2 years and we're still going to be outside there for another 18 months as well. And there are those risks that things don't go as well as assumed there because we have some pretty favourable assumptions sitting in these projections that give rise to that steady, quite significant fall in inflation that we project to occur. We've got nothing weird going on with commodity prices or energy prices. We've got no exchange rate depreciation. We've got a relatively weak global outlook. These are all things that can potentially change on us as we go through the next 18 months or so. So hence, I would say there is a fair amount of risk around that inflation profile. And from the central bank's perspective, those risks are asymmetric. Because if it turns out that something comes along to drive the inflation rate down a bit faster, well, I would have thought that would be gladly received by them because it means they get back to target a bit quicker. And they've already been outside target for a long time. The chances of them going through the bottom of the target at this stage look pretty remote, to be honest with you. Whereas like anything that lengthens that period of time, that makes it quite a lot harder. And, we could end up with basically it not being another 18 months, but another 2 years or more, and with the potential for sort of needing relatively high interest rates to get it back there as well. So there is that kind of asymmetric kind of risk profile that we think the Reserve Bank will be thinking about here. And indeed, most central banks in the world got the same kinds of problems. If you follow what's going on in the US, for example, they're sort of angsting a lot about exactly how easy it's going to be to get inflation down from the relatively high levels it's been settling at for the last couple of years. So this is the kind of detailed inflation chart, which is actually probably a bit more useful if you're thinking about monetary policy. It's what we call non-tradables inflation, and I've also got our assumptions for wage growth on there, bit of context. So non-tradables inflation is that component of the CPI which isn't really driven by import prices, the exchange rate, external kind of factors. It's the bit of inflation that monetary policy usually targets, basically to kind of to get inflation down. The thing about that one is that whilst headline inflation has peaked because a lot of those supply chain issues, energy price increases that occurred after the Ukraine war have filtered through the CPI by and large, what we're actually left with is this hard kind of rump of non-tradable inflation, which is really a function of the quite significant stimulus that was delivered during the COVID period, which ultimately probably wasn't really necessary given how we see how the economy actually evolved through that period. And that's the stuff that's quite hard to get rid of. That's why Adrian Orr and his team put interest rates up 5.25% last year or so, because they knew they had to deal with this, right? And that's a big rise. Typically that non-tradables inflation might sit closer to 3%. And, between that and a bit of lower tradables inflation, you can get inflation at your target. In our model, we basically see that non-tradables inflation is going to fall quite a bit in the next couple of 3 quarters, simply because we've got a couple of old quarters of 2%-ish inflation dropping out of the calculation, going to be replaced with numbers closer to 1%. So that'll look good, right? We're going to see basically lower headline rates from that perspective for non-tradables, hopefully. If it doesn't happen, there will be trouble. Because it would basically mean that quarterly non-tradables inflation is still running around 2% per quarter, and that won't be very good news. But you can see this little shoulder I've got here on this chart, which basically says that, well, after that kind of quite sudden rundown to about 5%, 4 or 5%, there's sort of like a period there where it sticks around a little bit. And that's where the period in which we're going to learn just how tight monetary policy is. If the unemployment rate doesn't drift up, if the labour market doesn't ease off, then it's quite possible that that shoulder period will end up being extended, and it will require a bit more action to try to get inflation to take that next big leg down to where it really needs to be. A key kind of like issue there will be what happens to wages through this period. You'll see there that we anticipate that wage rates are still going to continue to rise for a while because wages lag the labour market and the economy. And we're still sitting there with an unemployment rate at 3.4%, which is, basically generational low levels, right? So there's no reason to expect right now for wage growth to really significantly be falling. It should still be going up as people kind of like do their negotiations, try to basically recoup some of what they lost from inflation in the last year or so. But because we assume that inflation will be falling as we go through later this year and into next year, and that the economy will be weaker, that the labour market will be weakening, then those wage rates should start coming off. Obviously, if they don't come off, then it will slow or delay the fall of inflation back down to target and require some kind of policy response. One thing I'll mention right now is that I tend to think that it'll be the correction of the labour market that will be really key to making this happen. So we can't, if we're still sitting here in a year's time with the unemployment rate still at 3.5%, there's going to be a very different outlook for a lot of things in these projections for everybody, right? And in our view, we're basically, in the Reserve Bank's view, we kind of see that the unemployment rate, labour market's still going to be pretty robust for the June quarter, the quarter that we're kind of like just doing the last third of now. But where things get interesting if you compare, say, the Reserve Bank to everyone else, is that the Reserve Bank anticipates the unemployment rate's going to go up by about 0.6% per quarter in the third and the fourth quarters of this year. That's what gets them that extra slack quick enough to be able to bring their inflation forecast down into target. And I would have thought there might be some risks around whether that's really going to happen that fast, particularly when you consider that when we looked at the first quarter employment reports, what did we see? We saw very strong employment growth. We saw a further fall in the unemployment rate, and we saw a rise in the participation rate to record highs. So basically all of these migrants that turned up, they were absorbed into the economy. That's why employment growth was so strong. And the participation rate went up, which means a few other people lurking around in the economy without a job found one. That's a pretty strong picture. We did see some weakness in some other indicators that were perhaps a little bit more cyclone related. But it feels like quite a big difference in conditions from those first quarter data to where the third quarter data is supposed to tell us in terms of whether this economy is going to turn around fast enough to generate the sorts of outcomes the Reserve Bank thinks is quite likely at the moment. We're a bit more sceptical. That's why our unemployment rate projections are a little bit less negative in terms of going up as fast as they have. And that has inflation implications. So going back to our interest rate forecast again, we see a case for further tightening of interest rates, bring it up to 5.75% in August. And, some risks that we could go a bit further from that depending on how the data evolves over the course of the next 6 months. There are some complications here in terms of the election. There's a lot of speculation around about how willing a Reserve Bank might like to be involved in shifting interest rates in the immediate period before election. I think they'll do whatever they have to do. I think if you look at the data to see what they do, you can certainly see the case that it's quite a lot less it has been less likely to see an interest rate change in the 3 months before an election, but when it does happen sometimes, and when it does happen, the Reserve Bank has never been unhappy about increasing interest rates if they think it's required. So it's not the case that it definitely can't happen, but I suspect the hurdle is probably a bit higher, and that's what Adrian Orr and his team have been telling us, and they say that they feel confident in their view right now, but they're looking at the data it's the right thing to do. You should look at the data, and if the data tells you need to do something different, you should change strategy. That's what we'll be doing here at Westpac as we look at the data as well. So risks. A few risks here to think about. First one, in terms of this migration cycle, as I mentioned, we've got a pretty muted outlook for house prices in our projection, reflecting that kind of investor pricing kind of model that I just took you through before. But if you look at the historical relationship between migration and house prices, you can sort of see that there are certainly periods there where migration at anywhere near the sort of levels we're currently seeing has been associated with quite strong house price growth. Because it can drive rents and it can drive house prices. And I will say, as a personal anecdote, I have seen this movie before. So I was sitting on the MPC through that big migration cycle you can see there in the early 2000s. Kind of went something like this. When it first came on the radar, one of the analysts from the economics department turned up at MPC and gave us a paper, said, "This is interesting, migration's quite strong." And we all looked at it and thought, yeah, that is quite interesting, actually. We better keep an eye on that. Then 3 months later, turned up again, still quite strong. And the MPC would sit back and think, oh, that is actually getting quite interesting now. I wonder if it'll have any implications for inflation in the economy. 3 months later after that, they come back, yeah, it's actually still really strong. Now we've got house price growth, we're seeing some inflation, exchange rates going up because the markets are anticipating rate rises, and we would have to start moving at that point, basically, to try to catch up. From my perspective, that situation is a lot more comfortable than the situation the Reserve Bank is in now, because at least back then inflation was within the target usually. We're miles above the target right now. So whilst you perhaps have the luxury to sit back and wait and see and give it the benefit of the doubt, it's not clear to me that the Reserve Bank has that luxury right now. The implications would be, for example, if we ended up putting something like 10% house price growth into our projections, we'd have to upgrade quite a lot of things about what's going to happen with growth, inflation, through the projections, and potentially have to build in quite significantly higher interest rates to be able to counteract that, which would not be fantastic news, particularly if you spend a long time waiting to decide what to do, because you could end up with things having a decent head of steam up before then. Another way of thinking about it is if you look at that chart there and you look at that kind of like line, one part of that chart looks a bit different to the other, doesn't it? Like the forecast horizon is basically just going sideways, whereas like the history is much more volatile than that. And that tells you that's probably wrong, realistically. We just have to work out which way it is wrong. That's why it's a risk. And as I explained, if that upside risk does emerge, well then how do you see that planning out into the inflation outlook? Well, we did a scenario in the QEO to try to give people a feel for that. It doesn't really affect what's going to happen to inflation really in the next few quarters or so. It's kind of really filters through a bit further out, sort of like a year or 18 months into the future. And that's actually also the policy relevant window, and you consider that when you move interest rates now, probably doesn't really impact on inflation for another 18 months. That's why it is quite an important issue for the future interest rate profile, that if you start building in a bit more kind of like migration and associated inflation impacts in the medium term, then it does have a significant impact on what you think the policy rate needs to do, either in terms of future rate rises, or certainly in terms of derailing any hopes you might have for significant interest rate cuts through that projection horizon. I told you before our story about migration and how it's based off the visas numbers. And there's that number that I've told you, 370,000 more people have gotten a visa than have turned up. We put 100,000 in. A reasonable person could come up with a different number than that. And there's also been more visas issued as we go through the balance of the year anyway. So what is that number going to be? What if it is something closer to 300,000? We didn't put those sort of numbers in, and you probably, if you did put those numbers in, you're either going to end up with stonking population growth this year, or realistically, it's probably just a long-lived migration cycle. And a long-lived migration cycle would have long-lived effects on the growth outlook and the inflation outlook as well. It wouldn't be implausible in that sort of scenario that we would be looking at perhaps even a structurally higher level of interest rates compared to what we saw pre-COVID, for example. Maybe you wouldn't reasonably expect interest rates to ever go back to 3.5% again. We haven't taken that view at the moment, but that would be one of the things to kind of think about planning your business. And the last risk issue I wanted to talk to you about was the current account. We don't really have the current account deficit correcting significantly. It's going to get better than the really terrible levels it's currently at. But it's still going to be lurking around that kind of 5% of GDP type level, which is quite high even by New Zealand standards, where we've grown used to having a current account deficit, perhaps more closer to about 2.5% or 3% of GDP. The thing about the current account deficit is it doesn't matter until it does. And the thing that it could impact is the exchange rate. If the certain factors came into play, that might make investors less keen on investing in New Zealand because they see some kind of like risk, kind of like profile. Maybe it's because something bad has happened out there in the world. Maybe it's something bad that's going on in New Zealand. But either way, if that was to translate to a significant fall in the exchange rate, then you'd be adding a good amount of tradables inflation on top of the non-tradables inflation that are already in that projection. And that would further delay the return of inflation to the target range. And whilst normally the Reserve Bank would like to look through tradables inflation that's been caused by exchange rate falls, if you're already that far above the target range, you probably don't have that luxury, because otherwise you'd be accepting that inflation expectations, wage expectations would end up getting embedded at relatively high levels. We've got not very much in our exchange rate projections. We've basically got a bit of an appreciation, which is a reflection of an expected depreciation in the US dollar. Imre's going to have a few words to say to you about that. But, that's another area of the forecast that could easily be wrong as well. Thank you very much. Imre.
Thank you, Kelly. And we'll see we've chewed up the hour. So for those who are time constrained, do feel free. My bit's about another 10 minutes, so I'll try and keep it reasonably succinct. So much goodness there from the macroeconomic side. A lot of new things for people who come here regularly. You would have spotted migration, a big news story, even the housing market one. So a lot of good stuff to take on board and then plug into the interest rate and currency market views. We're looking at Kiwi-US exchange rate for about the next month going lower, 59 cents. Then by year end, 67 cents. As Kelly said, that's mostly a US dollar story. I'll elaborate in a bit. Kiwi-Aussie, lower, down to about 90 cents. It's two things. It's interest rate difference and it's the China recovery story. In short-term interest rates, we think more or less sideways, lots of volatility though, and then eventually lower. Longer-term rates though, not entirely clear that they are ready to fall that much. They might follow a little bit lower as the 2-year goes down, but not by too much. So a big sideways range there continuing, which means yield curve shape steeper, or in other words, less inverted than they currently are. The Kiwi-US forecast, what did we say last time? We kind of had a down and an up, and really it was more or less a sideways range. So directionally, not much happened in the last 3 months, but there's plenty of volatility. You notice at the tail end we were picking that the Kiwi would start rising as the US dollar was expected to weaken. That story's been shunted out by about another quarter. I'll explain why in a sec. But for the near term, a bit lower still, so over the next month, two main forces dragging the Kiwi lower. Firstly, we had a very dovish surprise from the Reserve Bank last week. They surprised the market by stopping their hiking cycle, or so they say, and interest rates and the currency fell pretty sharply. That's going to resonate for a bit longer. Second story is the US dollar has been quite resilient, especially over the last month. Their economy has been stronger than expected, stickier inflation. The Feds had more work to do, pushed rates higher than expected. On top of that, you've got debt ceiling wrangles, which perversely lift up the US dollar. We can get into that debate later on, but that's what's going on. So the US dollar is quite strong at the moment. So roughly over the next month, I think there's more downside potential for the Kiwi US. But eventually, this weaker US dollar story that we've been waiting for a long time, but we've got to wait for the end of the Fed cycle for that to happen. The Fed's been one of the, arguably the most aggressive central bank in the world, and as a result, its interest rates look a lot more attractive than they have historically. So people have been piling into the US dollar. That's going to reverse once the tightening cycle finishes, and then they start to feel the effects on their economy eventually. But we're not obviously seeing that just yet. So that's probably a story for maybe 3 months from now until about the end of the year. And then into next year as well, we think that story will continue, driving Kiwi US even higher still. And for those who need convincing that the US dollar story is the big driver of the Kiwi US, especially right now, look at this chart. You can see very recently it's the mirror image, and you can see there's been quite a bounce in the US dollar. That's in red. I think that's going to continue for at least another month or so. So the markets, the Kiwi US market is influenced more by the US dollar recently than it normally does. Normally other things also matter. Those other things don't matter that much right now, or they haven't for the last few months. Another source of support for the idea that the Kiwi can rise over the medium term, valuations. I think fair value for the Kiwi right now, according to one of our best models, is about 64 cents. It's actually trading about 60. It's quite undervalued. When do these misvaluations fix themselves? They take a long time. And as I say, the market's really fixated on the US dollar right now. It doesn't care what commodity prices are doing, doesn't even care much what risk sentiment is doing. It's just following that US dollar direction. It's saying every other currency is doing the mirror image. So that's where we are now. But I think eventually, when that US dollar story kind of runs its course, the US dollar fades, then these other things will matter. Then the currency will revert towards its fair valuation, and clearly that's in an upward direction. So that's the Kiwi US. Kiwi Aussie. We're pointing it down, all the way through to the end of the year, and that's two big things. It's the China story. We were expecting to see a better China recovery story by this point than we have, especially recently. Some of the data has been quite horrible, but we think that's just a reflection of an uneven recovery story. So China came out of its lockdown late last year, and the early signs of that were quite promising, and then we're going through this sort of soggy patch, but we keep the faith. Some of the very high frequency indicators, I was talking to our China economist from Sydney earlier this morning, and he's seeing a lot of promising signs in some of these very high frequency things that, in the second half of the year, we will see a lot better numbers coming out of China. A stronger China story does usually support the Aussie more than the Kiwi, so Aussie outperforms. Secondly, there's another channel through the industrial commodity prices. So again, a stronger China story will mean very strong industrial commodity prices, and they've been quite weak lately. So as they pick up, Aussie will outperform the Kiwi. So that's our expectation for the rest of the year. The second bit is interest rate spreads, and interest rate spreads have been very powerful as an influence on this cross for about the last 2 years. Markets have been very closely watching between the RBNZ and RBA. They're two closely related economies and central banks, so the sort of contrast between the two have been quite heavily traded and still are. Interest rate spreads, usually they look at the shorter term ones like the 2-year here in red, but they do look at the others as well, but really focus on the red one. You can see that they're near historical highs. They've come off a bit. They certainly came off last week when the Reserve Bank of New Zealand surprised us. And we think over the next 3, 6, even 12 months, they're going to move in a downward direction. They're going to move off those historical highs, and New Zealand's yield advantage over Australia will shrink. That will push the Kiwi-Aussie cross downwards. On to interest rates. So we thought kind of sideways, big range, lots of volatility, and then eventually a fall. Yes, we got the volatility. We almost got the 100 basis points, more or less sideways. Didn't get the fall. This new stuff that Kelly's talked about, mostly migration and housing, but other things, have surprised. it's meant that the outlook for inflation is stronger, which means that the Reserve Bank's got more work to do. So we're essentially pushing out last quarter's forecast into the next quarter, more volatility. Eventually, though, and it might take until the August meeting at the Reserve Bank here for you to see that downward move get into full swing. So eventually we'll see those short-term rates falling, but it might take until after that final rate hike that Kelly and team are talking about at the August meeting before that really starts to happen. But lots and lots of volatility in the meantime. Why lots of volatility? We look at market pricing. That's in the black line there, which is a depiction of the market's bets on where the Reserve Bank's going to put the OCR at future meetings. And you can see over the near term, not too different from Westpac. They're putting in about a half a chance of another 25-point hike at either the August or October meeting. That's what they're betting on. But further out, they're calling for a fairly aggressive rate cut cycle quite early, much earlier than we are. And we would probably disagree with that. Now, the volatility in rates will stem from surprises to the market whereby they shift that black line either up or down. So if you get the kind of data that Kelly's been talking about, I'm pretty sure the market will be surprised upwards. It'll abandon some of its view that rate cuts are going to happen so early, and you'll see those bets rise, pushing swap rates higher in turn. On the flip side, though, if you get a lot of weak data and we're surprised, the market's going to be encouraged even more in that downward direction. What's the direction the market really wants to bet on for the medium to long term, like over the next 6 to 12 months? It is rates falling. And not just here in New Zealand, but everywhere in the world. The really big money made by speculators is going to be how much they correctly bet on the next easing cycle. So that's the big trade. That's why they're piling into this early. But of course, they're going to be too early as they normally are. So we'll see how that one pans out. It does mean, though, they'll be fixated on a daily basis to the economic data that comes out for their country and trying to determine, does that mean central bank rates going to be higher or lower on a frequent basis? And that's going to cause lots and lots of volatility in rate markets in the near term. So there's that. And the second big source is overseas. Overseas rates will matter for us. So even if everything here is pretty stable and we get no surprises, if you get surprises overseas, they'll move those market pricings and that will influence ours. You can see here that the two countries which New Zealand interest rate markets follow most closely, which is the US and Australia, move pretty closely with us. Well, we all follow each other. You can see that recently the trend is still an upward drift. I think you could paint a story of upward or downward surprises to those offshore rates of the US and Australia, and whatever they do, New Zealand rates are going to follow suit. So just say, watch out for these offshore markets. Offshore markets right now are in a state where they are scratching their heads over what we're scratching our heads about, is when does the central bank finish its hikes? At what number? And how long are they going to hold it there for? You can see here everyone's still essentially in tightening mode. Some have declared a finish, like the Canadians in red. They did that a few months ago. But then a few weeks ago, they started to have second thoughts. So maybe it's not really over. You can see the RBA in green. They were not the slowest off the mark, but then they became quite sluggish. And they're one of the smallest hikers of the big bunch. And they potentially have more to do. The blue line, that's the Fed. And by the way, this chart brings all of the central banks to a common starting date because everybody started at different times. This is just a nice way of comparing all central banks to see who's the most aggressive and who's the least aggressive. The light blue Fed are the most aggressive in terms of speed. They haven't hiked quite as much as us. They're only 25 points behind, but they've done it the fastest, as you can see here. And they potentially have more to go as well. So market's wondering, how high do all these people go? What are the ones who've said that they're finished? Are they going to restart again? Who's going to be the first to start rolling over and cutting? This is what is occupying the market's mind right now. And so, yeah, again, plenty of volatility as you normally do get around hiking and easing inflection points. And finally, long-term interest rates, so anything 5 to 10 years or beyond, they've essentially gone sideways. The big thing occupying the market's mind at this end of the curve is, do we get a lot more inflation? In other words, the central banks kind of underdo it, in which case those bond yields have to rise further, or do they overdo it and cause recessions, in which case those rates will fall. And you can see here the argument has not been resolved. So we're in a sideways range, and I think that's going to continue for a while yet. So if that plays out in this way, and you get these long-term rates not moving much, short-term rates eventually falling, you are going to get a steeper yield curve. Now, the curve right now is extremely inverted. A couple of weeks ago, we hit arguably record inversion. The short rates to the long rates were different by about 105 basis points. That is a record in modern history in New Zealand. It is anomalous, and eventually it will right itself and we'll get to something approaching a positive curve shape, I think, by year end, because by then all these central banks should be done. We should have a lot more clarity, and markets will be pricing in the next easing cycle much more aggressively. So that information, I think, may be useful for people who are considering hedging decisions. And with that, I'll finish up, and we are happy to take questions, Kelly and myself. Thank you.